top picks from Brian Madden. Brian, number one is J&J, the iconic U.S. pharma company, ticker symbol J&J in New York.
That's right, Paul. This is a giant in the pharma world. It's also got a medical products division and a downstream consumer healthcare division. The pharma division we like. It's large, it's got scale, it's got a portfolio of patents that we think is better insulated from what investors call the patent cliff than a lot of its peers for a couple of reasons. One is they don't have a lot of single drug concentration. There's a number of big blockbuster molecules in there, but none of them account for more than 25 or 30% of their overall revenue. And they've got a well staggered sort of expiry of patents so that it's not all expiring, all loading on 1 year, creating an imperative or a gun to the head problem that they absolutely must, find or acquire a new molecule to replace the expiring revenue. The medical products division deals in joint replacements, cardiovascular stents, contact lenses with the brand AccuView, and then finally the downstream or the consumer packaged goods division owns brands like Tylenol, Aveeno, Neutrogena, Imodium, and so on. Their plan is to spin off that division. That will likely occur sometime next year. We think that will unlock value as that segment re-rates towards its pure play peers like Church & Dwight and Procter & Gamble, which trade around 25, 26, 27 times earnings versus J&J, which trades at 17. So while we await that catalyst, this business is a stalwart. It's outperformed the S&P 500 in 5 of the last 6 corrections or bear markets. It yields 2.7%. I said it trades at an undemanding 17 times earnings. And so we feel pretty confident this is going to be a timely stock as we await that catalyst to unlock value with the spin.
Okay, we've talked a bit about the Canadian banks. Royal Bank of Canada is your second top pick.
That's right. So, Paul, I've been looking at and watching this stock since I graduated from university, and I think the dividend on the company now probably exceeds the share price when I graduated. But all that to say, it's just a tremendous, fantastic compounder. And whereas it was always the largest bank in Canada, and often the largest company in Canada throughout most of my 25 years in the business. I looked at it yesterday as I was preparing for the show. It's now the 7th largest bank in the world. So really a formidable grower domestically and overseas. Obviously, we all know the domestic personal and commercial banking franchise. Big presence in the U.S. as well, all over the place, really. California, East Coast, here and there and everywhere. Big capital markets franchise, probably on the cusp of top 10 globally. The dominant wealth management and asset management franchise here in Canada, and then smaller insurance and investor service and treasury businesses. Yields over 4%. Dividend has grown at a compound pace of about 8% over a decade. Add the two together, you've got a pretty good, highly visible line of sight to a double-digit return over a cycle. Banking is a business where scale and breadth and increasingly digital and technological sophistication matter. This is a leader. We think they're only going to further entrench that leadership here and abroad in years to come. So core part of the portfolio, you can buy it today comfortably.
Next one is a big Canadian stock that has made a big gain over 52 weeks and is up 14% this year alone. Not many large cap stocks can make that claim. It is the grocery giant Loblaw companies.
Well, yeah, that's right. So, Paul, I think we talked about this off the top of the show. We're looking to position the portfolio in companies that serve customers' needs, not so much their wants. Their wants should have been satiated over the last 2 years with all the federal largesse, the checks, and so everybody's got a Skidoo and a jet ski and a new video game system and a motorcycle and a deck edition and et cetera, et cetera, et cetera. That's done. And now budgets are getting tighter. Inflation is biting, resetting mortgage rates are biting, but we all have to eat. Loblaw is the #1 grocer in the country with a 27% market share. We think they're uniquely advantaged among Canadian grocers in an environment where pennies are going to be pinched. Frugality is going to be at the forefront as we get into slowing economic growth, eventually recession, job losses. Loblaw has the leading footprint of discount banner grocery formats, so things like No Frills and Maxi, relative to its rivals like the Sobeys and Metro chains. They also have a very strong private label program, better than their key rivals, and it's got a 35% penetration rate in customer grocery baskets. Again, we think that consumer trade down effect is going to be profound in this inflationary and eventually recessionary environment. People switching down from branded to private label equivalents, that's going to help. The other thing they've got is the dominant pharmacy in the country. That is a faster secular grower than grocery, given aging, demographics, morbidity, mortality, prescription drug trends, and so on, via Shoppers Drug Mart. And then smaller financial services and loyalty businesses bring data analytics and business intelligence, merchandising sophistication into the mix. We think this company is going to do very well. It's been a consistent outperformer in down markets, and this time I think will be no different. So,
Brian, Madden